get some perspective from Doug Porter. He's Chief Economist at BMO Capital Markets. For more, Doug, it's nice to have you with us. What was your overall takeaway on the GDP data?
Oh, I think there's no question that the main takeaway is that the Canadian economy had a lot more underlying strength than expected, not just in the first quarter of the year, which many of us put down to the fact that the weather was unusually mild, but even heading into the second quarter. To your earlier comment, I think the real eye-opener here was the fact that Stats Canada is estimating that the economy actually managed to grow in April by a couple tenths. Now, on the surface, that doesn't sound like much. But of course, keep in mind that we had that large public sector strike in the month of April. So if the economy saw any growth in April, there's two signals there. First of all, there's a lot of underlying strength, a lot of underlying momentum, and it can overcome these hurdles. And second of all, it's very unlikely that the economy more broadly will see a decline in the second quarter. And frankly, if you think back to the start of the year, many forecasters, including ourselves, were calling for at least a mild recession in Canada in 2023, and obviously we're a long ways away from that. We've seen nothing of the sort. Above average growth in the first quarter, and it looks like at least modest growth in the second quarter.
And those are generally encouraging trends. I think, though, every economic data point, Doug, right now is viewed through the lens of, well, what does it mean for interest rates? And that rapid ratcheting up of rates has been hard for a lot of Canadians to stomach. So how does the Bank of Canada interpret this kind of data?
So I think if we stand back, this set of data would not come as a huge shock to the Bank of Canada. In fairness, at the start of the year, the bank was actually one of the more optimistic forecasters. They were not calling for a recession. They thought the economy would grow by roughly 1% or a little bit better, and they've been pretty consistent on that front. And that's about where it looks like we're headed. Even on the inflation front, yeah, the latest month was a little bit of a disappointment, but not a huge surprise. Yeah, I would say underlying inflation has probably got a little bit more strength than they expected. So on balance, the bank is probably a little bit concerned, but I don't think there's quite enough there yet to get them to completely change course and to start raise interest rates as quickly as next week. I think it is going to be a close call. I think they're going to have a real discussion about it going into next week's decision. But I think probably what's more likely is that they'll signal that, yes, they're looking again at possibly hiking rates and certainly circling July as a very real possibility. And of course, what it'll probably come down to is, what does the next inflation number show? Like, do we get further deterioration in underlying inflation in the next month's report? Or do we see that it was just a 1 month blip and core inflation comes off a little bit? I do believe the next CPI is quite critical.
And do you feel like you're seeing enough evidence that inflation pressures will ease as we head through the rest of the year?
It's close. I personally think the bank actually has done enough. I don't think there's a really clear-cut case for them to hike further. But frankly, a lot of it does depend on what happens with wages and underlying inflation in the months ahead. And frankly, I think we need a little bit more evidence. I think the one convincing argument that can be made for the bank to actually get back at it and start raising rates is just how firm housing has been. To me, that's one of the real surprises in the last few months, is that when you think about it, what's the most cyclical, interest-sensitive sector of the economy? Well, it's housing. And housing has managed to withstand that mighty backup in interest rates over the past year. And it looks as if it's actually, starting to perk back up again. If I was the Bank of Canada, that would make me a wee bit nervous. And that may be the single best argument to make that the bank actually needs to do a little bit more to make sure that the most interest-sensitive sector of the economy is actually softening.
And obviously, given the household debt levels in this country, it's something we have to watch very closely. So if a recession gets arguably pushed off, does that mean there's still a recession potentially, depending on how this delicate dance plays out? Or is it possible, going back to some of your earlier commentary, that maybe we have been too gloomy overall about where the economy is headed?
Yeah, and frankly, I've been hesitant to use the R word. I mean, we have had a couple negative quarters in our forecast for quite some time, but this is such a unique cycle. Almost every aspect of what's going on with household finances is like we've never seen before. The massive excess savings, a lot of pent-up demand, even for motor vehicles at this point, an exceptionally strong job market, and loaded on top of that, we've had incredibly robust population growth, which helps put an underlying bid on both housing and consumer spending. So I'm a little bit reluctant to call what we're headed for over the next 6 to 9 months a downturn, even though we we still do have a couple negative quarters. This is a very unique cycle, and I don't think it's really going to be a full-fledged recession, unless the Bank of Canada has to go a lot more than this, and we're not expecting them to.